All right, welcome back, ladies and gentlemen. Thank you for tuning in to the Rob Review. I'm your friend in success here, Robert Morris. I'm really glad to be back with you live for what I consider the first show of 2024. Now, I know that I came out with what I was calling the how to invest the Rob Review way, the behind the curtain thing. Really, that was a bleed over from last year. It was me trying to set the stage for what I want to do this year, which is talk about investing from a whole different perspective. I mean, everybody who believes in long term growth in your money is investing in real estate or the stock market or the bond market. You're investing money, right? And a lot of people, you hire people to invest your money for you. And some of you have plans, but the majority of us has this herd mentality towards investing, and I hear it all the time of how you just don't understand how one year you're up and the next year you've lost 50% of your portfolio value, and it's got to be frustrating. And I want to help you cut out that frustration and think about investing like a CEO, and not in some kind of way that makes it, you think CEO investing, oh, it's overly difficult and complicated. No, no, no. This, I'm going to simplify it. I want you to think about your investment like a business, and a business has a goal. And so all your investments should have a goal. And that goal should be whatever it is for you. But we're going to talk in each of these episodes about goals that I have and be able to help you figure out one for you. So today, we'll talk about investing for long term portfolio passive income from dividends of $10,000 a month. All right, we're getting used to this new set here. Lee's here helping me out tonight, and I'm really just excited to be able to kind of do this in a new way. And so, in honor of doing this in a new way, I want to talk about from a fresh perspective investing for real lifestyle choice. See, I used to chase money in a really hard way, actually. And honestly, the longer I chased it, the more it ran away from me. And then when I stopped worrying about money, stopped thinking about money, started to get my finances straight so that money didn't run me, all of a sudden, money didn't matter. And I honestly believe that that's where everyone should get to, because once you get to that point where money doesn't run you, your life is better. Money is not, you don't even think about it as much. And really, you get to a point eventually, I hope, where you don't think about it at all. It's just there. That's what passive income is to me. It's income that comes in no matter what you do, and it takes care of your life. It's not about riches. It's not about private planes. It's not about island buying. It's not about a better lifestyle. It's about that check coming in to take care of your expenses, your food, your health insurance, your life insurance, your kids' college fund, your kids' health care, all the things you need, your kids' braces, which are outrageously expensive. $10,000 a month to me is a figure that and I believe most Americans, if you had it coming in every single month, not working for it, but passively, you'd have time to make the extra that you need, and your lifestyle would be taken care of with a cushion for inflation. So that's why the 10 grand. And to start that off with, we got to talk about where you can get that kind of money from dividend wise, right? So let's just show you what my portfolio looks like. Let's go to the ME2. All right. This is not my portfolio per se, but this is stocks that I own. And so, as you know, on the Rob Review, I don't just BS you. I'm talking about real stuff. I do. All these stocks are stocks that have been personally vetted by a team of researchers that tirelessly worked at and looked at every financial statement of every blue chip stock to figure out the best stocks for me to buy. No, that is not what happened. I am a simple guy. Here's how I chose these stocks. Really, really simple. I looked at who owned it, and I looked at what the stock had in common with what I wanted long term. And how much peace of mind value it had. And what I mean by that is, if you're buying a dividend stock, you're not buying it for exponential gain. You're not investing in, for instance, a silver mine or shares in a new tech company where, truthfully, the possibility of you losing your money is there. I mean, but the risk begets the reward, right? Now, here with dividend income, our only goal, remember, is to get to that $10,000 a month check passive. So it doesn't matter if the company really ever gains in value, but we want a company that's solid and that's growing, not exponentially anymore, but has been proven. So here's the step. Step one, I think you find a solid company that's global. Global company assets mean that it's not as wishy-washy with our economy versus other economies. There's always going to be some growth somewhere in the world for that company, so it's always going to pay a dividend, pretty much. I mean, and I know that's kind of a backwards way of walking my way out of trying to give you a 100% guarantee, but all I'm saying is that a company like Cat Tractor, UPS, Pepsi, Nike, what do they have in common? They've been around for long enough that they're stable growing companies. They're global and they're optionable, meaning they have options that you can use to protect yourself to downside, which we talked about before on this show. And they're not going anywhere, as far as I can see, barring some global catastrophe, for the next 10, 20 years. They're going to be here. Cat Tractor, you need mining equipment. You need equipment to do big construction. UPS, everybody wants packages coming out of Christmas time. UPS was super busy to my house. Pepsi, everybody loves soda. And Pepsi's in a lot of other markets where it's just becoming a thing. All right? Nike, just do it. I mean, we all love sports of some kind, and Nike is into sports like they're so linked into the sporting economy that they're going to be around for a while. So I suggest that you look for companies, if you're not going to use these, that follow along with this criteria, and you don't even ever have to look at a financial sheet. Now, you should learn to read them, but to do this, you don't need to know how to do it. You don't even need to listen to earnings calls, though you need to know what companies you're going to want to own to start. That's the crux of the strategy. You got to know going in, because you got to know that the company pays a regular dividend. As you can see here, these companies all pay a nice dividend, and they pay them quarterly in a different month of every quarter, so that you get that check every month. That's where it comes from, right? Cat Tractor pays a dividend in February, then UPS pays my dividend in May, and then Nike pays a dividend for me in April, and then Pepsi pays a dividend for me in March, and then going back around to where I'm always getting a check. And eventually, all those checks will add up to 10 grand every month, because I'll have roughly 8,000 shares in each one of these companies. Their dividends, by the way, are always growing. The Cat Tractor dividend I get now was not what it is. I mean, it used to be, I think, $1.15, and it's grown, right? It grows all the time. So roughly speaking, 8,000 shares in each one of these companies based upon their current price status gives you $10,000, give or take 100, in a dividend check. Now, when we're talking about that kind of volume, that kind of ownership, it's actually not a lot in the grand scheme of things. You don't really own a lot of the company. You think you do, because it sounds like a lot, and it does cost. Okay. The other, go to 2. The other piece of this is you can buy into REITs. Now, REITs are real estate investment trusts, and most of them pay a dividend monthly, not quarterly. So evaluating based upon this REIT right here, which I like, its ticker symbol is O. It's been around a while. It's Realty Corp. 40,000 shares, $3 a share annually as a dividend gives you $120,000. So that is the same thing. So we're talking, I've given you a myriad of ways to buy into this, because you look at a cat tractor price at, I think currently is at $292 a share versus, okay, I don't have that kind of dough. Well, this is $59 a share. So you can get in either place, right? Now, going to the next slide here. This is a trade. And this is where we get into the crux of this strategy, because once you pick the companies that you want to buy, now you got to figure out how you're going to go about building the income. I mean, not the income, sorry. Building the capital to later buy the stock. Because the strategy is not based upon you having roughly about $2 million you're going to need to buy any one of these stocks to $8,000 a share. Most of us don't have $2 million just sitting around waiting to be put to work. So you got to build it up. How do you build it up? You build it up by making a plan, picking a handful of these stocks. Let's start with Cat Tractor, and making a plan around what the stock does every year historically, moving around things such as earnings. Earnings is a big catalyst. I do a lot of planning around making money around earnings, so we're going to use that. The stock market doesn't move the same year in and year out. So the next piece of this, once you've figured out the stocks you're going to buy, is knowing where you're going to profit from the earnings. Every earnings is not created equal. January and February is earnings. It's one of the best earnings seasons of the year. Then from there, you're going into March, which is warning season. The market doesn't act the same. It has a lull and then usually a mid-March pop into April, and then a sell-off around tax time. And then May earnings, April, May earnings can be a good time, but not as strong as January, February. And a lot of times, like Cat Tractor here, you can see historically a trade come out of May earnings. In June is where I did this trade this year, but it's not always in June. This trade in particular was a place where I would take, say, $6,000 to $10,000 minimum, maybe more if you have it. Money that's sitting in an account that you're ready to put to work. You can do a less risky trade on the stock without doing any options trading and profit from the movement after earning, and then compound that money so that you can buy more Cat Tractor. So the second piece of this is trading in earnings. So you take Cat Tractor, you go historically back, and you say, okay, when does earnings come out and does it move around earning? You take it maybe 7-10 years back, and you do the research to see based upon the charts. Okay, I'm looking somewhere around this time of the year every year for a trade. You don't know how long it's going to be. You don't know how big the trade's going to be, but you can basically pinpoint and plan, okay, I'm going to do a trade on this stock and do a trade on this stock and do a trade on this stock around these earnings releases. Moving down the line from May into June, warning season, July, August, earnings season, and then coming out of August, you got a September, sometimes usually a pronounced decline in mid to late September that sets up a rise into October, November earnings season. Now, caveat to that is every October, there's the potential for a crash in the stock. You got to know that. You got to be ready for that. Why? Because it presents buying opportunities. I mean, it really does. You got to think different than everybody else. When everybody else is running for the hills, you're picking up stuff they left behind. So the buying opportunity comes out of the fact that money managers have to sell off their losses in October. And if they're not inept in doing that, they can cause, and most major crashes have happened in October in the stock market. So after that, the market takes a breather and you go into November. Now, if you look, here's the next trade that I did on Cat Tractor was in November, and that's cool. You can, all right, now you're looking at this trade and you say, what's the difference in these two trades? There's very little. They're both setting up the same way because stocks kind of have characteristics to them. And right after the earnings release, I'm sorry, go to the next slide there, man. Yeah, this is the one we're talking about. All right. Um, right as the earnings release, like right the day after, you can see down there marked by that little E, the earnings was released in November, and I entered the trade right after earnings, and it went up. It popped up a lot. And because I know, based upon doing historical research, that the trades on Cat Tractor last longer in November, December, January than they do, say, back in May and June, I bought a further out in time strike price for the options. Now I'm trading options. You're doing buying stock only, as this thing says right here. But either way, the upside potential is still the same. For this trade, I bought in November at 233 and sold in December at 288 when the market, usually going into December, takes a breather. Sometimes Christmas can cause a major pop, sometimes it causes a hangover, and then we're back to January. So you can see where the market has a calendar that makes it go round. And that happens year in, year out. Not every year is created equal, but certainly every month is not created equal. So you have to know that going in. And then you can, as you can see here, plan. I'm looking over here because I got my charts over here to the side of me. You can plan trade. Now, these trades are not buying and holding. They are buying and selling, buying and selling. Why? Because if you're starting out with whatever you're starting out with, you can't do anything more than that. So you got to be able to build your capital. And then knowing where you're going to profit from the earnings, you can then stack your capital waiting to buy into the stock for a long-term hold. Now, the long-term hold, in my opinion, should be looked at as holding for years. So you're not going to buy it off of a chart like what we're looking at here, which is a daily chart. All right, this is a daily chart. All right. The movements here, every one of these candles represents a day. So this trade here was a month long. Okay. Whereas when you stack the money from this trade, you're looking at the bigger chart, like say a monthly chart or a weekly chart, to watch a place where the stock would go down, set up, and then turn to go up for a buy point, which would allow you to buy into the stock and profit. Now, you say, Robbie, I'm holding this stock for a really long time. Why do I care? Well, you want to buy it at a place where you're going to profit from it as immediate as possible. And so you're going to have a cost basis in that stock that allows you to take some risk and also take a breather and know that, hey, my money has already grown. And then it's going to continue to grow because the stock is going to continue to go up over time. The company, if it's growing, the stock price will eventually reflect that growth. So, yeah, you're not going to make money as immediate as you are trading. But if you wait and plan and look at, for instance, May, June, good place to look for long-term buys, or October, November, good place to look for long-term buys. You can look at a long-term chart and do it, and take the money you made from trading the earnings and be prepared to buy. And so looking at Cat Tractor at the next piece here, which is a longer term chart. This is a weekly chart. Every one of these candles represents we're going to go to the big, each one of these candles, you can see it a lot easier because they represent a week, so they're longer hold. So they're not trades, in my opinion. They're buying and selling, buying and selling, buying and selling, but you're not selling the stock. See, you're buying the stock, and then at the sell point, you're actually doing what I call protecting your downside. You can look at it like you own insurance on a car to protect you in case a crash happens. Well, a stock, eventually it's going to go down. So it's even more necessary to be able to have a way planned out that when the stock does go down, you're not going to just hold it and hope. You're going to have a way to protect yourself. And that's what that sell is. And each one of these sell points was a place where the chart was set up to go down. And then as it declined, I did a put trade. If you're against doing, options at all, because we're just talking about stock here, can sell calls against your ownership in that company. If you sell the covered calls, you're going to get money right then, and then you're going to take that money, set it aside, and then when the down is over with, when it looks like it's over with, you're going to take that, you're going to buy back the call, pay whatever they cost, and you're going to take the difference as profit, and you're going to wait for it to turn to go up again. And see, as you can look at this chart, and I don't want it to go big yet. I'm just trying to get out of my own way here so I can talk. It's a stair step going up. You can draw on your charts lines and plan where each one of these actually happened right around the time where I expected it to happen historically. So this first buy point here for buying into Cat Tractor to get those dividend checks, you're buying in October of 2022 after a downside move, and you're buying in at like 170, maybe 180 a share, I think is where I bought it. And you're watching it go up and up and up and up. And it doesn't go up forever, but you're profiting in your long-term position. And every single month, you start off with, say, 100 shares. So that's going to cost you, $18,000, give or take. And every single quarter, you're going to get a dividend check at that $1.30 dividend. And you're going to take that money, in my opinion, set it aside. And that's another stream of income for you to wait for the next buy point and put more in. And so the second part of this chart where I sold the covered calls, or where you would, or you could buy a put, the downside move was really profitable. And that would be in February. Now, I talked about February having a downside possibility to the market. It historically does happen. And so you would be planning that could possibly happen, and then the charts verify it, and then you profit. And then after that, you're looking at the May earnings as being a potential place for you to do an earnings trade. It could also be a potential place for you to buy more of the stock to hold. So you're taking that money, you're buying more, and each time you say you buy 100 shares, that's what I do, 100 share block, right? And then you see where it's getting ready to turn down again. And so what do? You package those 100 share bundles up into 2 bundles of 100, and you sell covered calls against it, or you buy put, and you profit from the downside again, and then you buy again. And now you'd be holding, like me, with 300 or more shares of Cat Tractor in your portfolio, getting a decent little dividend check every quarter at $2.90 and some change a share. And yes, if you held through all those downsides, you'd still be at $2.90 a share. I understand that. But the difference is you would have been sick at your stomach losing your money, because You don't know it's coming back, and you wouldn't have been able to profit from it like I did. And so that is the beginning of the strategy of how to stack that money. I mean, major stackage going on, brick by brick, allowing yourself to eventually see where, okay, that was just 1 year. If that happened every year like that, I could do 2 or 3 trades on cat, 2 or 3 trades on another stock like deer, 2 or 3 trades on another stock. I could take that money and I could easily see where I could eventually have a huge ownership in the stock by starting out with a very little bit of capital, you know? And that's what I hope you get out is just the overwhelming sense of I don't have to have my money working for me all the time. I don't have to be worried whether I'm going to be able to cash out my 401k and live off of what I got. I can actually keep my money in companies where it's working for me and then get paid for them using that capital. That's the way I see it. It's no different than me going down and joining in a partnership with Joe Blow that opens a bicycle shop and me giving him the capital to start the business with. No different at all. And he gives me a check as a owner of that company, as a capital provider for that company. John Deere, Cat Tractor, Nike, Pepsi, they all give me a check because I've given them capital to work. Now, the next episode, we'll talk even more in depth about the differences when you add in option to this and how the compounding can happen even faster. And so, with that, I'll see you on the next one. Remember that, look, life is what you make it, and it's a choice. You have to choose to be disciplined with your money. And a great man told me one time, I try to live by this: patience and discipline will make you a fortune. The lack of it will leave you frustrated and working until you can't even get out of bed. And which one would you rather